Okay, welcome everyone. We'll start our lesson 3. Today lesson will go through LO3. LO3 is the learning outcome 3. In this learning outcome will go through be able to interpret financial statement and make a justified recommendation. During lesson 1, we discuss about uh, different standard. We went through IAS 1, International Accounting Standard 1, how we can prepare and present financial statement. We discuss about different types of ownership, sole trader, partnership, limited companies, and charities. Sorry, but we discuss international financial reporting standards, conceptual framework, qualitative characteristic about financial statement. We also discuss about how many types of financial statement we prepare in accounts. So we discuss about statement of comprehensive income, statement of financial position, statement of cash flow, and statement of change in equity statement. So that was in our discussion, which we discussed in the previous lesson.
Okay. Can I just interrupt? The course today, this morning, so I've got 2 classes with you. First class is to deal with corporate strategy, and the second class is this afternoon at 2:30 for financial reporting.
No, you have 2:30 is a law for accounting.
Law for accounting.
Yeah, because that's your subject. You've been invited. And this one, of course, we are delivering. And if you need to, so you can, of course, you're attending as well.
Okay. Okay, so this one is for which subject?
Is a financial reporting.
Okay, financial reporting. Okay.
So this is reporting and other is a law for account.
Okay. Okay, so the link that I got that you sent me last week says corporate reporting for strategic.
Yes, corporate reporting, which is, we also call financial reporting.
Okay, advanced, business advanced.
Yes, sorry, I just used the word financial. So is a corporate reporting actually the title of this subject. Okay, so indicative content, what we're supposed to be learned this lesson, calculation and interpretation of financial ratios. We'll go through different types of ratio, liquidity ratio, profitability ratio, working capital ratio, the efficiency ratio, resources utilization ratio, and we'll interpret these ratios, how we can use it, and justified recommendation, and we'll go through how we can meet relevant party, different stakeholders, what purposes they use these ratios, and how we can interpret them and to make effective decision to measure the performance of the company, because the performance near to different people have a different interpretation. Maybe some looking the profitability, some looking growth, some looking tax, some looking turnover, some looking salaries. Yeah, so these can be application of relevant accounting standard. That will be in our discussion, and we'll go through various the gaps, general acceptable accounting principles, FRS financial reporting standard 102, which is UK standard, because if I not been used, it's been is a local standard. IFRS is the international and FRS is local standard, which is financial reporting standards. So that will be in our discussion. Okay, so these are all assessment criteria: evaluate accounting records, make justification recommendation, analyze useful accounting ratios, and evaluate. So we can do with all these in. Okay, FRC, what is called Financial Reporting Committee Council. They have different types of the companies. We can say the micro company, the small company, the medium or large company. So Financial Reporting Council has issued a suit of change. The large response implementation is a new EU implementation directive, which is include the new standard FRS 105, which is applied into UK, which as a part of was finance, still not all the legislations change. The financial reporting standards applicable to the micro entity and regime, and the new section 1A is a small entities FRS 102. This is all about, we can say, is a law really, we need to be look around, is it company falls when we do audit or we prepare accounts. The changes is necessary to continuous comply with the company law. So that is crucial with the company law to look around. Annual review FRS is reduced disclosure framework. Yeah, you put under the notes and the key notes. The main change is effective accounting period beginning from 1st January 2016. The main application permitted to the accounting period began on or after. So that's that's the dates really key. FRC is also made available overview the financial reporting framework. We describe the financial reporting framework applicable in the accounting period beginning from 1st January. It's include the key different financial reporting standard and new requirements under 105 section of this financial reporting standard. Okay. FRS 102 and FRS 105 micro. The definition of micro entity is contained the section 384 and 38. This is a little legislation under the company law. Main thing when we'll say micro, it's come under the turnover. So turnover is 362,000. Balance sheet total worth of the asset is 316. And number of employees is 10. Then it's come this under the company and the legislation micro company. Reporting options FRS 105. Yes, so which is 1 year only. The section 1 of FRS 2 is EU and disclose, this is main purpose to look around and how we can disclose the information under and the limit of the micro company. That's been changed and replaced, and that's been updated the section for the company law. So micro entity shall not be restrictive to change accounting the followed under the previous financial reporting framework. Okay, so they carry on, but the in future from that date, so we need to be looking around recognition of the financial assets and financial liabilities and all which we need to de-recognize under the micro entity previous accounting framework before the date of transition. Of course, always the transition period. So because financial statement, one of the quality should be comparable, comparative figure. So if you're changing something this year, you need to make sure you change the previous year. So because 2 years figure should be comparative. If that's not happen, like if you changing the depreciation rules, and this year you're using straight line, other year you used to be diminishing balance method. So you have to make sure the previous year is a diminishing balance method as well, because otherwise your figures not represent the true and fair and not comparative. That's the key purpose of these. Okay, user of financial statement. When interpreting the financial statement, it's important we look around who's the user and what information contain. Shareholder, potential investors. Of course, shareholders is looking the dividend, they're looking the consistency, they're looking the business will carry on, business is a going concern, and the supplier and lender, they concern about the security of the debt. Because they borrow us money and they get their money back. Management is concerned about the level of profit, so they look, the company is successful. That's why sometimes creative accounting come. Other potential users include the financial institution. Implies is more interested their job stability. Professional advisors also looking the company's information and make the judgment. Financial journalists and commentators, they also looking these financial performance. Okay, ratio. So what is the ratio? Ratios is all about, it's use the simple calculation based upon the interaction set of the data, two types of the data, yes. So you have a numerator, denominator, you compare with two elements. So example, change in the cost of the sales are directly linked to the change in the sales activity. So let's say, if the cost of the sales increase, like at the moment, due to the inflation, base rate went up to 5.25, and that's leads to increase the cost, and increasing the cost leads less demand. Of course, it costs you more, you demand less, and ultimately sale will be less. So there is a link. Ratios also allow us to see those interactions are the simple and concise format. Ratios are the limited use there itself, but we need to be look around the following points should we serve and use the checklist, and you need to analyze the data and comments on it so we can interpret. Sorry about. So we need to be look around the ratios. We can categorize into four. Of course, we learn in different subject ratios as well. So profitability, liquidity. Liquid mean the anything you can convert into cash, or cash itself is the liquid. Financial position, what is the position of the company in the financial, is the gearing and interest cover ratios is come under. So please, we use the formulas: current asset divided by current liability, current asset minus inventory, because inventory stock sometimes is a less liquid, sometimes maybe that's outdated, that's expired, but still is showing in our financial statement. Profit from operation divided by finance cost, and non-current liabilities, total equity minus the current liabilities, sorry, plus current liability, because the non-current liability, you borrow the money for the sake of long-term investment. So there is a link between, that's, which will. So next we look the profitabilities and use of resources. Of course, there are a number of ratios, but we are using, some of them. Return on capital employed, those are the most important. ROCE, profit from operation, which you can find the figures from the statement of comprehensive income, or we call income statement, profit and loss. Total equity figures you can get from the balance sheet, and plus your non-current liability figures. So let's carry on. These are the profitability, profit from operation divided by total asset, profit from after tax, which we'll carry on looking at. So we need to make sure we'll carry on doing these, and that will help, to uh to measure the performance properly. Thus we need to look around. Any question?
So just to determine these calculations, which also I have done in my work, these are all to do with corporate tax, business tax, nothing to
No, it's if you're working in, let's say you're working as a manager in the company, you're looking the measure the performance of the company, and you are interested in these ratios. Yes. So various stakeholders is used for different purposes. Yes, tax authority, they also use these. Yes, to look around their profitabilities and things and performance, and they paid the right taxes or not. So it's different purpose of these ratios.
these taxes would be very specific. So we're talking about balance sheet items that appear on the tax side. The tax would be corporation tax, or if it's a sole trader, income tax, but only related to the company's profits, not VAT, not any other tax.
Yeah. So VAT is expense for the business. So VAT we put as expense. So if your VAT will reduce your profit, it's reduce your actual cash position. So that's represent in the financial statements. As expense you can.
For this calculation, the VAT is already built into the profit.
Because VAT is linked with the sales, sales and purchase. Yes.
We don't use VAT in after tax, profit after tax, do we?
Yes. So VAT is a value added tax, input and output tax. Yes.
Yeah.
So input is a purchase and output is sales. So that's adjusted figures in the sales and the purchase. What is their net values? Huh? That's the key,
That's the key. So return on equity will be the profit.
Yeah.
After,
Equity mean the shares, what investment you have in the business and what profit you generate from the operation. Like you invested 10 million. So what what percentage return you have? Like if you can compare across industry, like, oh yes, we are getting 20% average in food industry. We are getting in service industry this return. Yes, so on. So we need to be look around these. Huh?
would you share with me any examples of how these calculations are applied?
Okay, tax always come after meeting all the expenses, which I'll show you in the financial statement in a minute. The last figure we say profit, net profit before tax. Yes. And then we'll pay the tax on the net profit before. The net profit will be after the finance cost, which is mean the interest. If your business borrow the money, you pay that interest. Huh? Okay. So that's, after that, whatever the money is left, you have to pay the tax first. And then after the tax money left, you pay to the shareholders as a dividend. You don't pay all the money to the shareholder what left. You pay the certain proportion of the dividend because your dividend is a consistent policy. If last year you paid 3 pence, this year you can pay 4 pence per share or 5 pence per share, depends. Yeah. So you don't need to give all the profit to them because maybe the next year you have a loss. So you carry on paying from the return earning. Huh?
So you'll share with me some figures
Yeah.
from a working financial statement by these points. These
Yes, so it depends, because the companies have different dividend payout policies. Huh? So sometimes bonus issues, buy one, get one free, and so many different policies can be within the company. So that's, we can look around the company policies separately. Okay, so next we inventories and turnover. These are also known as the performance ratios, cost of sale divided by inventory, how many times inventory, how many days we hold the inventory. So we can use these formulas. Trade receivable, how many days we collect the money from our debtors. Trade payable, how many days took us to. Always these two we compare because the receivable should be quicker and the payable should be takes long. Then the difference between receivable and payable days, that's we call safety net. So you have a cash, yes. If you immediate pay to the debt to the creditors and you receive money later from the debtors, which is mean your customer, so then of course where the cash will come to meet your running expenses. So that's why very careful. That's come the concept of credit management. Huh? So inventory in days, receivable days minus payable days, that's we call working capital cycle. Then revenue divided by total assets, we can look around asset turnover and we can look around revenue, total asset minus current liabilities. So we can look around asset turnover, net assets. Huh? Net asset mean the asset which meeting all the like accounting equation, total asset minus in liability equal to net asset, and net asset figures always equal to capital, which is equity. Okay, so financial statement, main objective of the financial statement help user to make the economic decision. That's key. We can look around internal, external, we can look around different calculation, and we can comments on these ratios, which we'll look in the following. So you've been given all the formulas, those will use, and we've been given the little interpretation of, like I mentioned earlier, ROC stand for return on capital implies. That's the total return made by the company on the both loan, debt, and the share. And judge, the profit earned in relation to the source available. Yeah. ROC depend upon two things: profitability, C, the operating profit percentage, and the resources and the asset which you use. So that can be use different formulas. Profit from operation divided by equity plus non-current liability equal to profit from operation divided by revenue, or you do times revenue divided by asset minus current liabilities. Your figures will come the same ROC, yeah, which we look here. Then we can look around the different variations, return on equity figures. We can calculate profit after tax and total equity. Equity means how much share capital you have. Huh? And here profit we use after the tax one, because that's you're looking, that's actually you have profit percentage and expenses ratios. We can look around how much we have. These all liquidity is most important, these two ratios. Yes, current asset divided by current liability, that's the most liquid. Current asset minus inventory. Inventory sometimes is not liquid, so we take out and we can. So this is normally benchmark 2 to 1. £2 worth of asset and £1 worth of liability. But it varies industry to industries and companies to companies. But you can say 2 to 1 is near to the most in a list, is the very sound or the good company's financial position. Then again, his argument can be the nature of the business. The current asset minus inventory, this should be 1 to 1. £1 worth of asset, £1 worth of liability. If it's come here, we'll go through in a minute. Actual data that will help us. Okay, so we can look around liquidity ratios use and other resources use. These ratios is all the explanation shows how rapidly business inventories are sold, average during the period, which we can compare 2 years. Financial position are gearing. So if you drive in the high, gear is a high risk. So if your gearing ratio is increasing or compared to the competitor is higher, so you can say your company is more risky than others. Oh, okay. Interest cover mean the money you borrow and you pay interest. How much interest you paying every year? How much profit you have? How many times your profit is a higher? So you comparing 2 years, you comparing with the industry average, you compare with the competitors, and you can look around. That's which company is less risky, because if your profit is a higher 10 times last year was, and this year is only 5 times your profit is higher than the, it mean your company is becoming more risky because you're making less profit. And if you next year drop further, that will be very difficult for you to pay to the creditors. Creditors is really looking these ratios very close. Okay, so these are two examples we pick, and we collect the data from their financial statements, Anika and Papika. Okay, so Anika's gross profit was 16,200, and their sales, are we called revenue, was 36,000. So we're looking first profitability ratio. So if you divide it, their profit and times by 100, because it's a percentage you have to convert. So we can look around. This is came 45%, and Papika's came 52%. So which one is the better? If you just look the gross profit, so Papika's is better performance, which is 7%, 7.5% is a higher. So our interpretation can be, if we are comparing two companies, we can say gross profit ratio show the relationship between the gross profit and the sales. According to this, the Anika's is 45%, Papika is 52.5. Papika's is better performance because Papika's gross profit percentage is a higher than Anika's. Yes, their margin is a higher.
But they may look to get that may be using different materials for selling at a premium. So that's not showing the true value of how they generated their
Yes,
profit.
you're right, because that can be credit sales and that can be manipulated. So that's why we can suggest it. They have to look around other factor as well, not relies on just one this. Yes, we
Exactly.
can.
Stock valuation can be manipulated.
Yes,
Use a
yes.
different.
Creative accountant can. So that's why, if maybe you look before COVID-19, your figures absolutely fine. But then COVID-19 happened, you have to keep in mind the COVID-19, not just on the financial, because that's end of the year's figure. Because few days in the real world can be many, yeah. So that's you're right. Okay, then operating profit ratios, profit from operations divided by this sales. So we can look around Anika's Limited divided by sales, that's 9% and 11%. So according to this, still is Papika is better. But when we look the gearing ratio, gearing mean like if you drive a high gear, high risk. It means you borrow high money. Huh? So debt divided by debt plus equity, that's one formula. This is 13.26%. So debt against equity is 13%. So which is quite good, 13% they have a debt. But if we look the Papika is 71%. So Papika is more risky. So in real business, we'll say higher the risk, higher the return. So if you look the higher risk percentage is a higher more than 50% between this, but the return is only 7% higher. So you have to look around. Is it make sense?
What if the interest charge on the debt is lower for Papika? So Papika's loan from borrowing the finance is only 1%, whilst borrowing interest.
So we can look around interest cover. We can embed figures into yes. You can look around as a whole as well. Huh?
Yeah, we have to look beyond.
Yes, you're right here. So you keep in mind those as well. Okay, debt divided by equity, that's 15, and this is 245%. So that's a huge difference. So if we compare risk point of view, you can say, come on, Anika is better, less risky. No doubt 7% is less return, but the risk is very less, yes? So that's why we say we do portfolio investment. So you don't invest money all between two. You can invest money in many companies, chunk, and overall your risk can be low and your return can be go up. Huh? So that's why we use the standard deviations and ANOVAs and all others, in the securities. That's, we do a analysis. Huh? So profit from operation divided by interest paid. If you have, that's also known as the finance cost. This is 11.6 times our profit is higher than the interest cost. You will see here because their debt is less, they have a less risky company, and that's why they're paying less interest. So 11.6 times their profit is higher than the interest elements. And this is only 3 points. So next year, if the 3.1 time their profit drops, so they can't really meet the interest amount which they're supposed to pay. Yes. So that's, the very risky. So maybe you as a lender, you say, come on, you only give to this company. You're not giving to 3.1. That can be your credit, or you will give very high interest rate. Huh? So current asset minus inventory divided by current liability, we can look around these asset tests as well. And that's, which we earlier mentioned, we look around, this is 1.22, 2 to 1, we said 1 to 1, this should be, and this is coming 1.2, which is good because, your asset is 1.2 pence and your liability is 1. And other is, their asset is 0.6 and their liability is 1. So that's, it indicates that the Anika is well off and well, the company performance compared to any good financial positions of the company. So the company performance may be compared from the previous period. We can look around the past result. We can look around different analysis, we can ratios sometimes it's weak, it's not mean. We need to be look around other factors as well. Different horizontal analysis, you can try to overcome the problem of vertical, compare the company performance to the particular period of the performance, or you can compare with the same period. You can look around different benchmark, you can compare with the competitors, you can compare with the industry averages. Yes, what is the industry is saying about average, and what your average, how much you are above or below the average of the industry's performance. That's also is a good indicator which we'll carry on looking at the financial analyst or management accountant, which will carry on managing. Consider your strategy. The ratios may also help you based on you consider the business strategy. There is a cash problem, there is a liquidity problem. Maybe you can change to the direct business model. You are assembling in India, Dell computer, you're selling throughout the world, and you just need to be look around. Yes, turning a business around, making changes can take a time. Yes, sometimes things maybe get worse before they get better. The ratios focus in the past, they don't analyze and tell a whole story. So we need to be look around impacts. Yes, concentrate, help to make the decision. Investing and leading the business should consider the impact of doing business ratio. The profitability business, yes, with the poor liquidity may be improved by taking the long-term loan. So you can make different. Okay, so different stakeholder, they have investor help to determine whether to buy, held, or sell the assets. Potential investors, they help you to determine whether to be buy or sell. Lenders, of course, they're looking the loans, interest to be paid. Supplier, they determine whether the company is owing them, will pay it, and all the decision different people, like we said earlier as well, they can make. Now we based on our analysis, we can say any gross profit per Pika is better. Anika is less risky. Anika is less risky. Anika's asset test is better. So based on all the ratios overall, we can, as an analyst, whatever your name can be, so uh we can draw the conclusion. So I would advise to invest in a Nika instead of Papika, because that is Papika is the more risky and return only 7% higher. And even you can embed your figures in your decisions as well. Then you've been given the links, please, if you want extra bit and pieces, you want to ratios and you want interpretation of ratios and decisions. That's you can look around. Other than that, you can look around past political, economic, social, and technological factors as well to make the proper decision. Okay, so today lesson, guys, we just learned about the ratios, interpretation of ratios, and small, medium, and some legislation. And if you have any question, please drop me email. Our next lesson will go through at the next our elements. Thanks for attending today's session, and hope I'll speak to you during our next lesson.
Our next lesson is this afternoon, isn't it?
Yes, yours is for law for accounting is of course 2:30, and this financial reporting, of course, tomorrow morning.
Tomorrow morning, 9 o'clock.
9 o'clock. Yes.
And will you send me the link?
Yes, I will send you the recording and I will speak you 2:30.
Thank you, sir.
Thank you. Thanks for. Bye-bye. Bye.